A very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan, Chief Currency Analyst, consulting on behalf of HYCM Group. I do hope everybody is well and you can see my screen and hear my voice okay. Great to see some good familiar names and faces here. Salvatore, welcome. Nikita, good to have you. Johan, good to have you back. Ignatius, you too. Horatio, how you doing? Gabriel, Farhad, Eddie, good to see you. Elaritza, oh, that's super. We've got a really nice crowd here today. Yeah, I'm doing good, Nikita. I hope you're doing well. Yes, got some good things to share today. Something learning lesson for the Bank of England inflation data, the UK inflation data rather, which came out earlier this morning. There's a potential swing trade that I can see setting up here in the euro pound. I'm going to share what my views are on that. And big week next week with the core PCE print coming out for the Fed on the Friday of next week, and also the Federal Reserve decision next week. So we've got some big events coming up. After next week, I'm going to be away on holiday for a couple of weeks, but hopefully we'll go out with a bang in a good way. So don't forget, as I'm looking at different entries, exits, different trading scenarios, this is not from a signal trading service, so I'm not telling people what to trade. It's like you're looking over my shoulder and I'm showing how I, as a professional analyst, make sense of the market, and I show you my rationale. And the idea of that is that that helps you when you go to make your own trading decisions. You sort of, you can hopefully learn from that sort of process. It's not a signal trading service. Now, the stated event I'm going to be looking at this week is the US initial jobless claims. It could offer a potential tradable opportunity, so I'll explain the rationale, but the best opportunity that's going to be coming up now is going to be the core PCE print next Friday. But nevertheless, I'm going to share this with you as well as the inflation data that we had for the UK. So there will be value here regardless. Now, first of all, let's just start looking at this UK data that we had. Now, you can see here that UK inflation data is surprised to the downside. The core came in at 6.9%, below the 7.1% forecast. It was in the range of the minimum maximum expectations, and the UK headline inflation fell 7.9%. Now, that was significant, below market's minimum expectations. And you can see also, that quite a lot of PPI misses. That's producer price index, so that's the cost pressure that producers are feeling to to manufacture goods, etc., etc. And you can see some of those revised lower. So take that as a broad brush. What does it tell you? It tells you that UK inflation is less problematic. Now, if you look at the positioning in the COT report, what you can see is pound longs have been very, very stretched. Look how stretched they are. They are at an extreme level of pound longs. And the reason we've been seeing pound longs so extreme has just simply been because of the interest rate market pricing. If you look over the course of these last few weeks, and if we just sort of focus in on the UK data, we started the month off with some very high wage data out of the UK. You can see here it was the 11th of July, average earnings coming in very, very high. That was just confirming the more hawkish pricing we've had from the Bank of England. And, a week ago, short-term interest rate markets were really expecting, 6.15, 6.18% plus. So nearly 525 basis points expected for the Bank of England, right? Now, that has dropped now significantly. And the reason that's dropped today is because of this low inflation print. So people are less likely to see the Bank of England needing to be aggressive. So what's that? That's weakness in the pound. So that's why I sold the pound US dollar out of that decision and just took profit as I hit that S2 pivot zone. You can see that the euro pound now there's the potential for the euro-pound pair to reverse higher. Now, if you look at it technically, you can see we're bouncing off that 100 exponential moving average. And if we just look at the bond yield spread between German bond, there isn't a European bond, so you use the German bond as a proxy. Look at the bond yield spread between UK and Germany, and this gives you a good indication the bond yield spread. Let's just get rid of that. Go. Right, and what you can see is the bond yield spread is starting to move back to the upside. Now, typically, you see the euro pound will track the bond yield spread. When it doesn't track the bond yield spread, it's when there's signs of distress. So that's why when we had that, remember we had that weird event in September, we had that funny budget from Liz Truss, and we saw the pound sell off and the bond yield spread move, in this direction. That was signs of distress. But normally, you see when the bond yield spread moves, you see how the euro pound tracks it. And if you look today, you can see, what are we seeing? We're seeing the bond yield spread just surging back higher. So that means I'm expecting the euro pound to keep gaining now, because the rationale is next month, the inflation data should show another significant fall. And the reason for that is, if you look at the okay, let me just drag that across, right? If you look at the UK inflation data, you see the core reading has finally come lower. And you can see the headlines finally come, a bit lower again today. Now, these prints are April, May, this is for June. So today's print that was released, that was for June's release date. We are now in July, right? Now, what's expected is that this is expected to fall even lower for July's print. Why? Because there's an energy price drop that's only happened this month in the UK in July. It's affected businesses, consumers. Myself, the company contacted me and said, okay, we're dropping, our prices are dropping. That's affecting everyone. So that's going to come into the inflation print, especially the headline. So this should drop even more next month. So when I put that, I think, okay, look how the pound is so stretched, those longs have been stretched on expectations of steeper interest rate hikes. It's much less likely that the Bank of England is going to need to be aggressive now. You can see, look at that big gap that's opening up. So all of a sudden, good news for mortgage holders in the UK, this should fall. So given the fact that the Eurozone, they're meeting next week, they are kind of, expected to hike in July. That's the expectations, 96%. And then it's a bit more of an open book what happens in September. Short-term interest rate markets are divided. But what I would expect to see is the pound falling, was if the ECB have to turn a little bit more hawkish, then the potential for euro pound upside is significant. Like technically, right? So you've got the bond yield spread moving higher, right? Let me just get rid of it. We've seen that. And then the euro, look, it's pushing back above that trend line. Okay, yes, this is big resistance, but if you look at it on a swing trading perspective, I wouldn't be surprised to see this continue gaining. Right, we've got a little bit of a swing point. You've got a trend line broken here to the upside. So for me personally, any retracements back down to that level is suitable for buying. Okay, and if you look at it on the monthly chart, if this closes, and we've got quite a long time to close, but if this closes above last month's highs, then that does indicate a move back up towards that 0.8900 region. Okay, and because you see, what you'll be seeing is a bullish engulfing bar. Okay, potentially engulfing that from key support. See the way the the 100 exponential moving average, support, resistance, broken higher, support-ish nearly, support, right? So we're in that sort of support level on the monthly time frame. So stops could be placed just underneath that 0.8500 region, looking for a move up higher. Obviously, the key place to find and manage risk would be this trend line. So as long as I stay above this trend line, I'm happy to go with it. If I move back below that trend line, I'm going to feel less confident. Okay, and you can see that large trend line here that we're breaking back above from this. See, so touch. Okay, price trying to break. If you get a break and close above that on the weekly chart, then what I would expect this to then act as support. So at the moment, this is acting as a resistance, which is exactly what you'd expect. You get this big resistance level, but the other alternative is to wait for the price to break through here and then wait for a retest and then look for a move up to that 8.900 region. That's a potential. Now, there's a lot that can go wrong. It's a very large time frame. It's a sort of a couple of months swing trade potentially, but something to be aware of. The other alternative would be potentially a pound yen short if we see very, very strong inflation data out for Japan. But the reason I'm not so keen on yen strength at the moment is because of these comments from Governor Ueda that came in yesterday. He said there's still some distance to sustainably achieve the 2% inflation target. So there's been speculation that the Bank of Japan would have to end its yield curve control policy. And if you look at the yield curve control policy, if you just take a look at bond yields, all right, just to see how it goes. There we go. Right, look at Japanese bond yields. They have been sort of capped in that 0.5, 0.25 band, and the Bank of Japan have been doing that deliberately. So every time it sort of moves up higher, they just buy an unlimited amount of bonds. They are not prepared to let that yield move. You see the yields stuck at 0.5. Look here in the US, you know, it's 3.7, Germany 2.3, 3.3. All these bond yields have been moving higher as bonds have sold off. Japan don't let the bond market sell off. They just keep buying it. Now, speculation has been saying, well, perhaps the Bank of Japan will change that policy. And that policy that they've been having is what's been supporting the weakness in the yen. And recently, and you can see here, particularly for the dollar yen, the yen's been strengthening, not only on falling US 10-year yields, but also speculation that will the Bank of Japan change that policy? Governor Ueda is pushing back against that yesterday. So if he hadn't said that, I would have favoured pound yen shorts. But with him saying that, I prefer euro pound longs. So that's that UK inflation outlook. So although it's not specifically what we're looking at today, it's worth mentioning, showing the logic and the rationale. So that's, you know, and the key place to limit risk is under that 0.500 region. Obviously, what would counter that is if the ECB have to be more dovish. So if they start saying, well, maybe we have to start not hiking rates so aggressively, maybe we have to start cutting interest rates even, then we expect the euro pound to fall. Okay, so that's what's going on there. Onto the data point that's worth looking at, and that is the initial jobless claims. Now, if you look at this jobless claims data, what you see is that yeah, also pound Aussie shorts would make sense if that's a big beat. So if that comes in very strong, the Reserve Bank of Australia are very sensitive to labour data. So strong labour data would send the pound Aussie dollar selling sharply out of that print at 2:30 a.m. So be aware of that. Looking at the initial jobless claims, now labour data is very important for the Federal Reserve. They have said that a tight labour market is one of the key reasons why they need to be aggressive in hiking interest rates. So if the labour market shows signs of weakening, that will mean the Fed need to be less aggressive. Now, if you look at the pricing at the moment for the Federal Reserve, is what you'll see. Nearly 100% chance expected to hike by 25 basis points next Wednesday, right? But the last dot plot, the Fed said they're going to hike twice. So that's up to sort of over 5.5%. That's what the dot plot said. Short-term interest rate markets say you're going to hike once and then you're going to cut in March next year. That's what short-term interest rate markets think. So what I'm looking for something that contradicts the Fed's dot plot and affirms the short-term interest rate markets. That big miss we had on the 12th of July with the US data, that CPI miss, right? If you look here on the 12th of July, see there was a big CPI miss, and this is what sent gold and silver rocketing higher. You had the headline coming in at 3%, below the 3.1% expected, but the core below market's minimum expectations and misses for the month-on-month headline and core. So in other words, less inflationary problems. That means in principle the Fed will need to do less. That's what led to the dollar selling off through that 101 region, which is what I was telling CNBC Arabia just before and as it was happening. So, you know, get a big miss here, then you could potentially see this fall. And that's exactly what we've seen. Big drop down in the dollar. And you can see here on the 12th of July is when it really accelerated through. Selling, and now price trying to find a bottom there, but sellers still very much in control. And we saw that big move up in big bid into bonds, right? And suddenly bonds are looking more attractive because you know, lower interest rate expectations. And you can see here that sell-off, that bid into bonds coming on the CPI print. You can see that a little bit more convincingly, okay? And if you look at this on the from a trend line perspective, you know, the tight trend line like that's a broken, that's you know, reversal. Buyers are coming back into bonds, and it's been very attractive at that level. Looked very attractive at the time. I've been buying into bonds myself, and this is, you know, looking for ways to do it, and this is just the confirmation that I needed. And actually, the confirmation that I needed was you may have missed this, but the drop in Canadian inflation data yesterday. We had this decent drop in the CAD data. It just gave me a little bit of confidence. Here, see, year on year, below market's minimum expectation, headline, core, everything lower. Great, right? Expecting that to weaken the CAD. And also, I thought, okay, if inflation's falling in Canada, look, it's now falling in the UK. Expecting it to falling in the US as well. So I think, okay, it's like the market's saying the worst of the inflation problems behind us. Then all of a sudden, you know, these high yielding bonds, right, start to look attractive. And that is what supported gold. That's what supported silver higher, right? You can see, is that silver making, yeah, that silver trying to make fresh highs now. It all makes sense. And that's why I entered gold and silver longs on that data from last Wednesday, and I'm still long silver and gold because of that very strong seasonal pattern. Do check out HYCM's blog. I've got loads and loads of, you know, decent insights there. Make sure you're checking it out. Yeah, Horatio, I was thinking you would be. Horatio said he's got his fingers and toes crossed for a strong Australian jobs. I've been short on the pound Aussie since Monday and has been weaker. Imagine where I'd be if Aussie can gain some strength. Yeah, right, Horatio. I'm cheering for you over here in the UK. So I hopefully I'll wake up tomorrow morning and I've seen a rocking jobs report. You know, jobs have been strong, and this is just me willing you along, right? But jobs market have been strong everywhere, so hopefully they're going to stay strong in Australia for you. Great rationale, by the way, Horatio. Pound Aussie dollar shorts just makes enormous sense, and you know, even if you get lucky, you know, yes, you might get lucky, as it were, but your logic has been sound. So you'll find more often than not, the luck comes to the people who've put in the right thing, the right thoughts, right? So excellent. So all of that we've said there is by way of saying that if I see a big jobs miss tomorrow, I'm expecting this to support gold long. Now, I am already long gold, right? So this will be, but I would still have this as a potential scalping opportunity, but personally, I might use some leverage, okay? But I'm long gold and have been from back, well, not back that far. Yeah, it was back that far. Yeah, 12th of July. Okay, so that's when I entered. I was already long gold. I entered another position on that print. Okay, so I'm still expecting more from gold as long as the outlook remains what I'm expecting: lower inflation, the Fed has to do less, maybe even some slowing US economic growth. If we see a big miss in the jobs data, then that is deflationary. Okay, so a miss in the jobs market, the rationale is there's less jobs, the Fed will be less likely to hike interest rates. If there's problems in the jobs market, then workers can't demand such higher wages. Deflationary, Fed does less. Dollar lower, yields lower, gold and silver upside, right? That's the rationale. So I'll come to it tomorrow, just before the release, and what I'm looking for is I'm looking for an overall miss in the data. If you just look here, US initial jobless claims, you can see that they're 200, they've been moving lower, okay? So this is the people who are wanting unemployment benefit, and the higher number, okay, is worse, because if you've got more people applying for jobless benefits, that's saying that the jobs market is deteriorating. So forecast is 242,000. What I want to see above 260,000, and I want to see continuing jobless claims above 1768. Okay, so if I see that, then that will give me an opportunity to go long gold or long silver. All right. So what I want to see initial jobless claims above 260,000, initial jobless claims above 1768. And I want to see the jobless claims 4-week average rising above prior. Okay, and I want to see if even better is if they got the prior readings revised higher. Okay, so there's the initial jobless claims. Continuing jobless claims, right, have been falling. If I can start to see them moving up in the right direction, that's what I want to see. I want to see the 4-week average moving back in that direction to the upside. So if we get a big beat in the data, I would consider a dollar-yen long. Okay, so big miss in the data, it would be looking at gold, silver longs. If it's a big beat in the data, I would consider dollar-yen upside. Why? Because of Governor Ueda's comments, right? So remember Governor Ueda's comments, right? We're some way off achieving 2% inflation target. Some of that recent yen strength can unwind. So that would typically be supportive for dollar-yen upside, right? Now, if you look at the dollar-yen, you can see that we're just retracing a little bit now. And remember, it tracks the US 10-year yields, okay? So that's a little bit of a divergence there. You expect sellers popping in here, right? We look at with the 10-year yields moving lower, right? But dollar-yen sort of moving to the upside. We expect some sellers there, but that's just by the by. If we get a very strong jobs print, in other words, less people are unemployed, less people are still unemployed, there's less people out of work, that's inflationary, so you expect yields to pop up, and I would consider a dollar-yen upside. Just a short scalp mind, but that's what I consider, but I would look to get out quite quickly. The gold and silver upside, I definitely feel sort of more confident on that. Is that clear? I mean, that's, yeah. Yeah, Horatio, you've summed it up well, Horatio. So if you look, I'm just going to show you what's Horatio saying. You know, what do you think on the Eurozone? It is a bit tricky, right? And this is because we've had a bit of a contradictory move. So ECB at the moment, before not said this, expectation is ECB a hike in July, and then they, you know, could be hiking in September. So expectations of definitely July, definitely maybe September, but now not. Who is more hawkish has said, okay, hikes beyond July are possible, not a certainty. So in other words, you know, could have hit an inflation plateau, right? So that's a bit of euro weakness. But then we've got Simkus out saying there's a clear need to hike in July. Option for a hike should be discussed in September. Would not be surprised if ECB continues to hike in September, right? So what do you make of that? Will that still support euro upside? For me, on the euro, I still see that being okay because I'm expecting the pound to retrace significantly. So even if that narrative begins to fade, I would expect the pound's kind of weak retracement to kind of still lift euro pound higher. But I recognize that as a risk, okay? And it is a risk, and it'll depend on what the incoming data is in inflation for the euro area. If you just take a look at the euro area, inflation headline, it is still 5.5, moving in the right direction. The core, though, is very firm. So I think if that core remains firm, you know, I still think they're going to be, you know, keeping that idea of a September rate hike alive as long as growth doesn't get crushed in the meantime. So cautiously optimistic that euro pound upside still makes sense over a swing trade. So that's my take on it, how it relates to euro pound upside. Yeah, it's a tricky one, right? And then it's just looking at incoming labour and inflation data. Expectations have dropped slightly, haven't they? So on current, but you can see CAD inflation missing, US CPI missing, UK inflation data missing. We're starting to see a bit of a theme here. So I wouldn't be surprised if you know, we see ECB a meeting next week as well, so we get a better sense from then, I think, Horatio. So at the moment, reasonably optimistic for euro pound upside. May consider taking it off before the ECB meeting next Thursday. So ECB meeting next Thursday. Let's just get the right. Let's just put them all back in. Yeah, 1:15 UK time next Thursday. Okay, folks, very good stuff. Thank you very much for attending, everyone. It's been an absolute pleasure. Don't forget, I am back here on Monday, and we'll be looking for the key data points that are coming up. There's a lot going on. You're right, Max. I'm looking at euro yen longs for the reasons you mentioned for both currencies. Thoughts, Giles? Yeah, Max, good idea. Right. So now euro yen longs are tricky, Max. Am I expecting the euro yen to gain? Yes, but it's a nervy kind of outlook. So euro yen should be gaining, right? And you can see it is gaining, right? Which makes sense. But you got Japanese inflation data coming out on Friday, Max. Watch out for this. It could really impact market. So yeah, wait, let me just get this. Late night Thursday, early Friday morning. That's it. So you got that Japanese inflation data. If that comes in really strong, okay, then the market is going to say, what are you talking about, Ueda? Inflation's too high. You're going to need to end that yield curve control. And then the yen will just find bids like you wouldn't believe. So the problem I have with that euro yen long is that at any moment you could get a tweak from the Bank of Japan, you know, or you could get a high inflation print late night Thursday, and that could sink the euro yen. The euro, as I said, it's quite sensitive to headlines at the moment, and we've had Simkus contradicting what not said. So on balance, I still think euro yen upside makes sense short term, right? Why? Because there's a pushback on both the ECB pricing and there's a pushback on the Bank of Japan yield curve control. So intraday trading, tight stops, being very careful, Max, 100%. The current sentiment does suit euro yen upside. Can't criticize you or fault you for it. Your logic is good. Be nimble, because the yen side of it could change late night, late night Thursday, early Friday morning, and potential euro moves could come if you get an ECB speaker saying something else. Dollar Swiss franc, that is heavily stretched to the downside at the moment, dollar Swiss franc. So very similar outlook to dollar yen. This has basically been that inflation play, Nikita. So when we had that very sort of weak US CPI data, we've seen the dollar fall off, and that dollar Swiss franc weakness is basically, as 10-year yields are falling, the dollar's falling. We've just seen the dollar fall across the board. So would I expect the dollar Swiss franc to continue lower? Yes. Would I want to be selling at these prices? No. If you've got a retracement back up to that sort of 850, 900 region, I would consider that suitable for shorting on a swing trading basis. But otherwise, that's quite stretched, so very hard to sort of selling at the bottoms. Swiss franc, is it possible? They have turned more hawkish as of late, and they are concerned about secondary effects. So the Swiss franc continuing to gain against the dollar makes sense as long as we've got, say you get a very, very weak jobs print tomorrow, Nikita, I expect more dollar Swiss franc downside. But if you've got a weak jobs print, rather than trade dollar downside, I prefer probably like euro US dollar upside, because it's a more natural kind of take on the dollar. Or gold or silver longs is what I personally prefer. But bottom line, it's got to sell on the rally bias. Very good. Thank you, Max. Thank you, Nikita. Been a good session. Thank you all very much for attending. We'll be, good, Nikita. I'm glad that makes sense. Thank you all very much for attending. We'll be back on Monday, and then the week after that. So I'm back next week on Monday, back next week on Wednesday, but the week after I'm away for 2 weeks on holiday. But it should be a ripper of a week next week. Don't miss it. Come, because I'm going to be sharing the key events. Got the Fed meeting, got the ECB meeting. I think we've got the Bank of Japan meeting next week as well. And we've got the core PCE. So there could be some wicked volatility next week, particularly in the precious metals markets and the dollar. So don't miss that. Take care, folks. Thank you all very much for your time, your contribution, as always. You're going to miss next week. Okay, Max. Yeah, just look out for that Fed meeting and the core PCE on Friday. Because if there's a dovish Fed and a miss in the PCE, then gold could be hitting all-time highs. That's really what I'm looking for potentially. Okay, there are risks involved as always. Fed policy, unexpected inflation data, unexpected reactions even, but that's bottom line. Take care, everyone, and look forward to seeing you next Monday. Goodbye. Happy holidays, Max.